So a major conflict flares up somewhere on the other side of the world, and almost instantly, you start to see the stock market move in some really weird, really specific ways. Now, this isn't just random market jitters. Nope. It's a chain reaction. Think of it like a ripple effect that starts with just one single event and then spreads through the entire economy. But how does that actually work?
I mean, that's the big question for any investor, right? You see these headlines about global tensions, and it's easy to think, okay, that's happening way over there, it's abstract. But the truth is, those events send shockwaves that travel right into your investments, turning something geopolitical and distant into very real dollars and cents in your account.
You see, the whole story of how the market reacts on a day like this, well, it all begins with the very first domino to fall. It's the one resource that pretty much underpins the entire global economy. And the moment its stability is threatened, everything else starts to get a little wobbly.
And there it is, oil. Almost immediately, in response to conflict in the Middle East, crude oil prices jumped, heading straight for $80 a barrel. And that right there is the stone dropping in the water. The immediate fears all about supply disruptions and the sudden higher cost of energy. That single price jump is what kicks off every other market move we're about to see.
Now, if you just glance at the major indexes, you might think nothing really happened. I mean, look at this. The S&P 500 barely budged, the Nasdaq was up just a tiny bit, the Dow was down a little. It looks like a totally flat, maybe even boring day on Wall Street. But trust me, that calm surface is hiding a really turbulent story of some very clear winners and some very clear losers.
So let's look right past those averages and dive into that first immediate splash. This is where you see the most direct effects. This new reality, higher oil prices, global tension, it creates an instant divide right down the middle of the market. Some companies benefit directly from this, while others, well, they get hurt, and they get hurt fast.
And the logic here is actually pretty straightforward. On the winning side, you've got energy companies like ExxonMobil. I mean, of course, the product they sell just became a whole lot more valuable. You also see defense companies like Palantir getting a boost because investors start betting on increased government spending. But on the losing side, the logic is just as simple. Airlines and cruise lines need two things: cheap fuel and stable global travel. With oil spiking and tensions rising, their entire business model is suddenly under attack.
And this split becomes crystal clear when you look at the individual stocks. I mean, on the exact same day, driven by the exact same piece of news, ExxonMobil rallied more than 5%. At the same time, American Airlines dropped over 4%. See, this isn't just random market noise, it's a direct, logical consequence of that initial oil price shock. For every action, there's an equal and opposite reaction playing out right here.
But you know what? The story doesn't stop there. After that initial splash, the ripples start to spread out, and they get wider and a lot more complex. Investors start to look past the obvious winners and losers, and they begin to ask a much, much bigger question. What does all this mean for the entire economy? So this is where the fear starts to multiply. See, higher energy costs don't just hurt airlines. They could push up consumer prices on everything, sparking inflation. And that, in turn, could force the Federal Reserve to put the brakes on any planned interest rate cuts. Faced with all this uncertainty, investors get nervous. They start pulling their money out of riskier stocks and running towards so-called safe haven assets.
And here is the direct result of that fear. Gold, the classic safe haven asset, it hit a new high. When investors get spooked by things like geopolitical risk and inflation, they often run to what they see as the safety and stability of gold. This price surge is a perfect reflection of that second ripple, that growing anxiety about the health of the whole economy. Which, believe it or not, brings us right back to where we started. This quote from The Motley Fool just perfectly captures the day's bizarre dynamic. Underneath the surface, you had these massive, dramatic moves, energy stocks soaring, airlines tumbling, gold spiking. But the market as a whole, it ended up almost totally flat. And why is that? Because for every single investor betting on a specific outcome, there was another one just waiting, weighing the impact, and holding their breath to see what happens next.
And ultimately, a day like this leaves every single investor with a huge dilemma. What do? Do you run for the safety of assets like gold, or maybe even just plain old cash? Or do you see all this volatility as an opportunity? Do you recognize that for every airline stock that's falling, there's a defense stock that's rising? It's the fundamental tension of investing, all brought into sharp focus by a single event, happening thousands of miles away.